private equity is continuing to fund these private corporations longer. I think it's a good thing. And I call this sort of the Patrick Mahomes effect. He did not start his first year. He sat behind Alex Smith, I think it was. Right. And what that allowed him to do was grow and mature and learn. Right. And then he started the next year and he was Patrick Mahomes and everything is wonderful. That's sort of the concept between keeping these companies private longer is instead of pushing them out, because I started in this business roughly 2000, right? And you go back to the late 90s and there's a lot of IPOs for a lot of companies that frankly probably weren't ready to do that. They weren't profitable. They weren't terribly well managed, but they got shoved out into the limelight and a lot of them failed. So private equity funds them longer. And I think that that's a wonderful thing because it helps them mature and grow.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group, and your host of the Guided Retirement Show, Mike Faciana. He is an executive director with a company specializing in private equity, more specifically, privately held companies. Most people think that it's impossible for the individual investor to be able to take part in that. That is not true any longer. Over the last several years, the landscape has changed drastically. We're going to be learning from Mike Faciana about what is the marketplace like for these private companies and what are some ways that you can get involved? Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. Please enjoy my conversation with Mike Faciana. All right, so Mike Faciana, good to see you, man.
Great to see you, Dean. I'm happy to be here.
It's been a little while.
It has.
Thanks for taking time to be on the Guided Retirement Show.
My pleasure. Happy to be here.
You know, the private equity markets, which is really what we're going to be discussing today, are a market that is really misunderstood by a lot of people. When you start talking about private equity, mergers and acquisitions, and all these things, I call it the average investor out there, the millionaire next door, they're like, their mind just kind of shuts off. Private equity, I don't know what these guys do. I don't know how they do it.
Right.
But I want to talk about private companies and why companies stay private and how do those companies value them? And do those companies that are private actually allow other people to invest in that company? Obviously, they're not selling the whole company to somebody, but they allow other people to come in and buy. So why don't you kind of give us a little bit of a history on the private markets themselves, which would be companies, not necessarily small companies. There's some very big companies that have chosen to remain privately held, which means that their stocks aren't traded on the New York Stock Exchange. So talk to us a little bit about the history of private equity.
Well, yeah. So let's say that you came up with a great idea for a business, a product or maybe a service, and you're just at that startup stage. What would you do? For most people, that would be, you borrow some money from friends and family, maybe get a small business loan, right? Let's say you're Jeff Bezos. Now go back 30 years. And it actually is true that he started Amazon out of his garage, right?
It's a fascinating story. If people haven't heard it, they need to read it or listen to it on a podcast because it's a fascinating story.
It's very common too. Actually, Microsoft, Google, Amazon, they were all started in either their garage or their parents' garage or friends or families. Apple is another one, right? So this is common. So you've got this great idea, and I decided I'm Jeff Bezos, and I'm going to sell some books.
Hey, there's another one. WeWork.
We could talk about that a little later. Yeah, a different category. Let's set that aside for a moment.
That was one that didn't work, right?
That did not work. Yeah,
they did a show on that, a series on that called "We Crashed."
Mass scale fraud is always a bad thing. So let's set that aside for a second. But going back to Jeff Bezos, right? So he borrows money from friends and family, and he buys some books, some inventory, and maybe he builds a rudimentary website that people can log on and buy these books. And business is going well, and he's starting to make some sales, and he'd like to expand that business. Where do you go next? The friends and family are sort of all tapped out. You can't get any more loans. And so what you do is, most often, is you go to a private equity company. Now, the earlier startup stage type private equity companies are called venture capital, and they specialize in these idea stage companies, not, again, working out of your garage. And they'll provide some funding and guidance to these early stage companies. And let's say 3 or 4 or 5 years goes by and business is building up and he's selling more books and wants to expand the inventory and upgrade the website. Maybe he'll borrow some more money from venture capital. Venture capital, I should rephrase that, borrowing money from, they actually invest and buy a portion of Amazon in this instance, right?
Right.
And that'll happen for, maybe they'll fund a company like Amazon 3 or 4 different times. And then, about year 5 or 6, venture capital companies, because they really specialize in these really idea stage early startups. And they don't want to get too concentrated in any one singular company. So Jeff Bezos says, hey, I need to expand some more. And they might say, hey, we love what you're doing. You're doing great, but we're out. Our thing is really kind of the early stage stuff, right? But Jeff Bezos has got to expand. And that's where the private equity companies come in, right? So they'll continue funding, buying more pieces of Amazon in this instance, and help them grow. Historically, if you go back about 20 years, the life cycle of a private company that's doing well, like in this case, like an Amazon, right? They're doing well, they're expanding, they're gaining traction, maybe not profitable yet, but really doing well. Usually the life cycle from first funding at venture capital, they'd usually IPO right around 7 years. That was about the average time from a startup to an IPO, again, in the instance where the company is doing really well.
And for people that don't know what IPO is, it's the initial public offering.
Right. So you'd list your shares of Amazon in this instance on a public exchange. You'd raise a lot of capital, and that would free you up to really expand and grow the business greatly, right?
So it's an influx of cash from the public because anybody can now buy into Amazon stock.
Correct. Now, the landscape has changed greatly over the past 10 or 15 years in this regard. Because like I said, it usually was about the 7-year mark that these companies would IPO. Today, on average, companies IPO in roughly 14 years. So there's a big difference now.
So they're staying private longer.
They are.
And aren't you actually seeing, Mike, companies go from public back to private?
We're seeing a lot of that. So if you go back 20 years, there was roughly 8,000 companies in the U.S. traded on major exchanges. Today, there's roughly 4,000, or about half of them. And a big portion of the reason why that is private equity is continuing to fund these private corporations longer. Now, if you're the founder of a company, why would you do that? Why wouldn't you want to go public? Well, there's a lot of reasons. One of the biggest reasons is the expense of doing so. It's very expensive to hire an investment bank and IPO. It usually costs you 6 or 7% of your company value. It's very expensive. On top of that, if you do go public, there's a lot of regulatory and SEC filings you have to do. So there's a lot of sort of administrative work that you have to do, and there's a lot of expense with that, and you have to hire additional staff to sort of manage and service all of that. The landscape changed in that with private equity keeping these companies so much longer in the private stage I think it's a good thing, and I call this sort of the Patrick Mahomes effect. When he was drafted off of Texas Tech, 3, 4, 5 years ago, right? He did not start his first year. He sat behind Alex Smith, I think it was. Right. And what that allowed him to do was grow and mature and learn, right? And then he started the next year and he was Patrick Mahomes and everything is wonderful. Would he have been the same player if he was kind of pushed out early into the NFL as a starter? I don't know, but that's sort of the concept between keeping these companies private longer is instead of pushing them out, because I started in this business roughly 2000, right? And you go back to the late 90s, and there's a lot of IPOs for a lot of companies that, frankly, probably weren't ready to do that. They weren't profitable. They weren't terribly well managed, but they got shoved out into the limelight, and a lot of them failed. So private equity funds them longer, and I think that that's a wonderful thing because it helps them mature and grow. And then as they reach that stage that they're ready, then they can IPO.
So when you say that we've gone from 8,000 publicly traded companies to 4,000, that doesn't necessarily mean that 4,000 publicly traded companies are now private companies because you've got the Lucent Technologies of the world, you've got the Enrons of the world, there's companies that just aren't there anymore, right?
Yeah.
And some companies were purchased by another company, and so that stock was swallowed up. But that's not to say that we haven't seen a shift of companies staying private longer or being public and being purchased by a private equity company and taking it back to the private side, right?
Right. Yeah. So that's a lot of what we see. A private equity company, about half of the time, they'll acquire a private company, right? And about the other half of the time, they'll actually acquire a publicly traded company and take it private. One of the benefits and one of the best things that private equity firms do, and the expertise that they have is they don't just acquire a company. They have on their staff teams of accountants and legal and sales professionals. So they acquire a company, but then they go in and they work with the management of those companies to help them run it better, right? So they're incentivized to do that. Private equity companies will usually invest in a company, get it running better, increase profitability, which i.e. increases the valuation of the company, and usually about the 10-year mark, then they'll sell it off. So they're really adding a lot of value to these companies, and that's part of the reason why the private equity returns overall are so much more significant or higher than what we're seing in the public markets.
Well, if you think about that just for a minute, so you said less regulation, less scrutiny. Look, if you're a publicly traded company, you got to forecast your earnings. You got to hit your earnings, right? And you're accountable to the stockholder. And how many times have you seen it where a publicly traded company is simply managing to hit a number as opposed to managing and running that company in order to increase the value of the company over time in a very significant way? When you're a private company, you're not running the company to meet next quarter's earnings or the quarter after's earnings. You're running the company to turn it into something much better over a longer period of time. And so if a private company misses a quarter of earnings, it's not the end of the world because there is no public market for it. And it's not like it's not public. Nobody knows because all they know is, hey, this is our like 5-year plan or our 7-year plan or whatever it is. And so it gives the people that are running those companies and the investors more autonomy to do what they know needs to be done without having to worry about, am I going to meet the quarterly earnings estimates?
Yeah, absolutely. One thing that's interesting too, there are the publicly available, i.e. traded on exchange companies in the United States that have over $100 million in revenue. There's about 2,600 of them, right? The private companies that have 100 million in revenue or higher, well, there's 17,500 of them. So a lot of the interest in private equity is really, you've got a lot of investors and a lot of advisors that maybe are a little uncomfortable with valuations. That old 60-40 stock and bonds that we've used for so many years, that's worked so well. Many have some uncertainties whether that's going to work for the next 10, 20 years, 30 years. And so they're looking for, sort of a blanket term, what we call alternative investments, which really just means anything other than stock and bonds. And so if private equity kind of fits under that umbrella of alternative investments, but it gives you access to, well, frankly, if we're investing in only publicly traded entities, that's 15% of the universe of companies, in my instance, that are earning more than 100 million in revenues. So we're only really investing in a small portion. Here in Kansas, the second largest private company in the country is right here in Kansas, right, with Koch Industries. On the Missouri side in St. Louis, Enterprise. That's, I think, the 10th largest private company. I'd love to be able to invest in companies like that, but I can't.
Well, until now.
Until now, yeah.
Yeah. Well, I think so. Let's kind of get down to this because the financial industry has recognized that there is a need and a benefit to allow the average investor access to these private companies that don't trade on an exchange. Now, obviously, when you start investing in these private companies, your liquidity rules are different. Your holding periods are different. There's things you have to understand and things you have to know before you do this, because this isn't a ticker symbol that you're going to, buy it one day and sell it 2 weeks later. You're not looking at the price every single day. You have to really dig in and do some research and understand who is this. And so there are actually ways where there are companies like yours. We need the listeners and the viewers to know that it's possible to invest alongside of the private equity people out there who really specialize in, hey, let's find the right company. Let's buy them. Let's get this thing grown up. And private equity, they're not dumb people. They know what they're doing, and they have a mission to go in and turn around a company or just drastically improve that company, increase the valuation over time.
Right. Yeah. And there's a lot of different, private equity, you're right. A lot of people hear that and they go, I don't know what that is. Right. And the reality is private equity can really mean a lot of things. Sometimes private equity means I'm buying apartment buildings that are private or public and I'm taking them private, or maybe I'm buying entire companies, or maybe I'm issuing debt. So there's a lot of different things that sort of fit underneath that umbrella. And then there's private equity companies that specialize like the venture capital, right? Which is sort of like the Shark Tank, right? Those are the guys that are funding Jeff Bezos really early on. And then the private equity guys will come in sort of in that midpoint. So there's kind of early and mid and late stage private equity on top of that. So a lot of the private equity firms specialize in certain segments of sort of the life stages of those private company shares. The one thing that I hear, and it's true, access to private equity investments are pretty exclusionary. And there's two main reasons. One of the reasons is regulation, right? The SEC says, which is a regulatory agency, the Securities and Exchange Commission, they say, well, you have to have a certain amount because, to your point, these are illiquid, right? And they do have a longer time horizon. So unless you have X amount in assets or make a certain amount of income, the SEC says
you can't buy them.
You can't buy these
and
things.
it's for the protection of the investor,
It
right?
is, absolutely.
And it's got to be there.
Absolutely. Yeah, no question. The second is this, though, to be able to invest in some of these large private equity funds themselves is very, very difficult to get access to them unless you can write a $10 million check, or unless you're a pension or a foundation or some large institutional investor. And the exclusionary nature of the private equity firms, and it's not that they're mean or they don't like us, right? It really is just math. So if I'm a private equity firm and I'm trying to raise $1 billion, would you rather have 10 entities investing 100 million with you, or would you rather have 100,000 people investing 10 grand with you? Well, obviously they'd prefer the former than the latter.
Yeah.
So it's very difficult to be able to actually get into some of the most successful private equity funds themselves. That landscape has changed a lot too, in that there's something and this is really new. So with private equity keeping private companies private longer, if you go back to even 2015, there were right about 50 companies that were valued at $1 billion or more, private companies, right? And we call that valuation level, we call those unicorns. Today, there's there's about 1,100 of them today.
And what year was the first part of that? 2015,
2015. So this is all very new, where private equity is keeping private longer, right? And these valuations are growing, which I think is a good thing, again.
So that begs the question, how are they valued? I know when you look at a publicly traded company, the value of that company's stock is pretty much whatever somebody's willing to pay for it.
Mm-hmm.
Okay.
Yeah, right.
It's kind of like your house, right? Well, here's the appraised value. That doesn't matter. It's what's somebody willing to pay for it. So how do these private companies get valuations to say, well, this is what we've done for the company, and this is what we think the value is now?
Mm-hmm. Yeah. So there are actually very definitive valuation stages for these private companies, and they're called funding rounds. So, and it's really based on, and it's not that different from valuing a public company. It's based on, hey, what are your revenues? What are your profits, if you have any? What are your sales growing at? Profit margins, all that fun stuff, right? So they'll go on and they'll have these funding rounds. So venture capital is usually the first 2 or 3 funding rounds, if you will. And each time they do a funding round, the venture capital companies will, again, look at the math, look at the numbers. That's one of the benefits they have, because private companies don't have to post their financial information, right? So how would you or I be able to make a decision to invest in a private company? We don't have access to that information. But if we're coming in as investors, then they'll open the books and let us see to be able to make those decisions. Interestingly enough, too, roughly 90% those within the first 3 funding rounds, 90% of those startup companies fail and go away. So that sort of early stage, you can make a fabulous amount of profit, but it's also very risky. So, we'll take a pass on some of that stuff. And then the private equity comes in, and then you'll generally have, before a company goes private, even today, A, B, C, D, E, usually around the H time is when companies are ripe enough, and each time they're valued, right? So you have very definitive, and that happens usually on average about every year and a half, maybe 2 years, you go through a funding round. Again, assuming business is doing well and you're growing. And
couldn't you also say this industry, multiple companies are sold in this industry,
Sure.
and this is the multiple that they sold at, and here's our earnings, and so we could take a multiple of that and apply it, and here's
Absolutely.
the estimated value of that at that point in time.
Yeah.
But this isn't something where the individual investor is going to look at their statement and go, oh, gosh, look how much money we made yesterday, or
Right.
what did we do? So there's less transparency there. So I think that a lot of people think, well, how do I know? How do I trust that? Right.
Right.
How does this new environment where the average guy out there, I'll call him the millionaire next door, can actually buy this? Is there any more transparency for that person than, because they don't have the private equity guys behind the scenes crunching the numbers and putting the valuations together and doing it on a regular basis? How do they know what's going on?
Yeah, that's a good question. And the reality is, while private equity is becoming more transparent, it's still a long ways from the public markets where they have to file like every quarter their financial information, their holdings and the like.
And they don't want to do that.
They don't want to do that. And frankly, there is, with the regulation, there is expense to doing that. So there is sort of this, sort of a wall where we as investors don't completely know, right? And I think that's why so much of when people invest in private equity, it's going to very specific top tier managers. And that's why they're so exclusionary, because we can't get in because they've got so much money coming in. The reality is we don't know, but something's cropping up. So we as a potential investor, we can come in and we sit down with management and we get access to their private financial information to help us make those decisions. A lot of companies, my company in particular, we focus on the very late stage private equity companies. So these are the companies that are big and strong, over $1 billion in valuation, revenues growing, and probably likely to IPO in the next 1 to 3 years. That actually is something that is actually an SEC form that a private company has to file their intent to go public.
Right.
So there is some information, if you sort of know the lay of the land and what to look for. There is some information to make sort of those decisions, but you're right. For individual investors, there isn't that transparency, and that's a problem for some people.
So would you consider the late stage purchase a more conservative purchase, or would you consider that to be a speculative purchase because you never really know what's going to be going on in the economy or the markets when they decide to IPO? So even though the company itself may look super healthy, and if they intend to IPO, maybe they IPO'd at the wrong time, like a 2008 type of time frame, or maybe they decided to IPO in the middle of COVID.
Yeah.
And so all of a sudden, what you thought the valuation was, the market opens up and it's discounted by 20% because of what's happening in the economy.
That's very accurate and very true. In fact, last year, the S&P 500 was up by 27-30%, NASDAQ about the same. If you looked at, there were 1,000 IPOs in 2021. And the average return of those 1,000 IPOs was negative 20%.
Yeah.
Right. And so we could look at some of that. Maybe it was the economy, what was going on in COVID and all that fun stuff. But there's legitimacy to that, because you see a lot of things that are doing really well because of what's going on in the economy or the world today. A lot of companies were hurt by COVID and a lot of companies benefited from it. And as we come out of COVID, are those still big, viable, strong companies?
Right.
And so one of the things that a lot of private equity companies like ours will do is, we vet, maybe 100 of these sort of late stage that fit our filters and parameters, right? And we'll meet with, out of 1,000 that exist, we'll look at about 100. We'll meet with management on about 80. Maybe we'll put an offer letter about 40, and maybe we'll buy 15 or 20 of those companies. So we spend a lot of time in research, whereas, a lot of,
hold on a second. When you're buying, are you buying the whole company, or are you just buying? You're taking a share of that company. Is it a majority share, minority share? How are you doing that?
Yeah, no, it's just a minority share.
So you just want to participate in what you think is an opportunity that's going to present itself over the next 1 to 3 years.
Right. Yeah, absolutely. And a significant change in the landscape, and this in part will answer your question on valuations and pricing also is, so in between those funding rounds that I just described, something has cropped up over the past really 5 years, even less, called the secondary markets, right? And there's secondary markets that have existed for, dark pools and all this stuff on, traded stocks and all that fun stuff. But what the secondary market is, and this kind of leads into companies staying private so much longer. So if you started at a startup company, right, for the most part, they don't have a lot of money to pay you. So you'll accept a smaller salary and maybe not as good benefits for what? The opportunity to get some shares, and this company goes public and you make a ton of money, right?
Yeah.
So we're doing that now. When the companies on average went public in 5 or 7 years, okay, right, I can do that. But now that it's 14 years, that's a really long time, because guess what? Life happens and people need money for whatever reason.
Right.
If I started a company 10 years ago, my kids were 15 and now they're 25, and maybe my daughter's getting married, or birth, death, divorce, life, whatever, people need liquidity, need access, and this time to IPO has been stretched out so much. So the secondary market has cropped up. And so roughly 50% of private company CEOs now allow their employees to sell their shares. So when a private equity firm comes in and buys a company, it's a little bit of a misnomer. They buy usually about 2/3 or 50% of the company, because the employees and senior management still holds the rest, right? And private equity will buy the other chunk, right? So individual employees still have those shares. Historically, they couldn't sell those shares. But now, again, because they're staying private so much longer, the CEOs have identified, hey, I need to provide some liquidity. So I'm going to allow, and roughly half of the companies today allow their employees to sell these shares on what's called the secondary market. So a secondary sale would be anything in between those funding rounds that happen every year and a half, right?
Let's call them recapitalization or whatever you're doing.
Yeah,
right?
Exactly. So a lot of companies, my company in particular, we go meet with the CEOs, and then more often than not, they'll say, hey, talk to these employees, right? We'll say, we love your company, we love what you're doing. Here's some, they'll refer us to some employees. In fact, a lot of the senior executives will sell their shares too, because a lot of their net worth, in many instances, all their net worth is tied up and locked up in those shares.
So they want an opportunity to take some chips off the table.
Right, absolutely. So the secondary market has cropped up, and that's frankly how we acquire these shares, direct from the companies, from the employees. And by doing that and providing liquidity to these employees, we generally get a discount to the last valuation. So that could be the last funding round. But this is sort of where a private equity firm has to have that expertise and know where to value, because if a funding round happens every year and a half, but the company's grown at 80% over the past 6 months, is it worth more than that? Probably, right? Hasn't grown at all. Is it worth less? So you've got to make those decisions on what to acquire the shares at. So that's called the secondary market. And now what we're seeing, there's actually online exchanges that have cropped up. So we have our own online exchange, and there's many others that do the same thing. I really believe within the next 5 years, it's going to be more commonplace where you can exact trades in private company shares through these online exchanges. We've got one built where we have over 50 institutions that execute buys and sell orders electronically.
So do you think that leads to more regulation from the SEC then?
More than likely, yes.
The one thing that the private companies want to try to avoid?
Right. So it's a little bit of a catch-22, because it's a benefit to the private companies and to the private equity companies to not have to deal with all that regulation, right?
Right.
So you're starting to see a little bit of a crossover where private equity is allowing a little more liquidity, sharing a little bit more of that private information, being a little bit more transparent. The converse to that is, and I think, what was it, last year, where now you can access private equity shares inside of your 401k. And I think there's a bill going through Congress right now where they're trying to lessen those standards that we talked about earlier. They're so restrictive about individuals. So actually, there's a lot of people in the government that are saying, you know what, that's not really fair. We need to sort of democratize access and let other people invest in these vehicles, right? So we're starting to see sort of both ends, but unfortunately, you're right. The end result might be more regulation.
I think we ought to keep government out of this deal.
Agreed.
They can mess up anything they touch, and we've seen that happen many, many times. So, so we know now from our conversation, Mike, that the private markets, and we'll call them private markets as opposed to private equity. Private equity funds the private markets to some degree. They make some transactions and they make some things happen, but it's really the private markets. It's the companies that are out there today that are really, really good, solid companies that until just recently, the general public has not had the opportunity to actually own any shares in those private companies.
Correct.
That landscape's changing. People now have access to it, but they need to do some homework. They need to understand what it is that they're investing in. Now, this is not your old, limited partnerships in real estate. It's not, something you're doing something for some tax credits or something like that. There's been a lot of things that have sprung up over the years, and I've been doing this now for 35 years, and I've seen about all of it. And so, just got to caution people, don't just jump out and say, hey, I heard, Dean and Mike talking about the private market, so I need some of the private market stuff in my portfolio.
Oh, yeah.
I got to understand where it fits and how it works.
Oh, absolutely. And that's why I tried to, kind of lay out the different stages, because you can go on some website and you'll see hundreds, if not thousands of private equity funds. And what are they and how do you know? And it's very sort of confusing what they do, what they invest in, what stage companies and the rest. So, and it's a big decision. So there's a huge difference in risk between those venture capital funds and maybe a late stage private equity right before they go public. We believe that that's where the best risk adjusted return lies in those big companies that are, they stay private longer and they're ready, they're mature, right?
You're probably not going to get the home runs, but you're going to get a lot of singles and doubles.
Right. So that is, so our contention is, and a lot of people's contentions is that, the money today is to be made really on the private side. Again, because there are so many private companies to invest in, and they're staying private so much longer that a lot of that profit that you would have seen if they had IPO'd at year 7 instead of year 14, that 7-year period is eliminated and is now on the private side, right? With private investors that are making that profit. When they go public, you got that 7-year window that's gone of those potential profits, right? So, we see, but to your point, it's even with stock and bond, there are 10,000 mutual funds and ETFs out there. How do you know? How do you decide? It's crazy, right? And that's why you have to work. You have to work with a seasoned professional to kind of sort that out and what's suitable for you, because everybody's so different, right? And it's the same thing with private equity. And I would contend even more so because there is not as much information available. I will tell you the most common reason for individual investors that they don't invest in private equity is just that. I don't completely understand what's going on there. I will follow it up by saying, and I meet with a lot of financial advisors, the most common reason I get from financial advisors that aren't using private equity for their clients is that same thing. I don't completely understand what's going on in there, right? So education is paramount in working with financial advisor, an investment advisor, more specifically like yourself, a fiduciary that has responsibility to doing the right thing for the client and seeing where that fits, or maybe it doesn't fit. For a lot of clients, private equity is not going to be suitable.
Correct.
Right. So don't just hear something that sounds neat and go, I want that. Right. This is definitely not for everybody, but for some people, it could be a real nice addition to their portfolio.
I would agree. I mean, it's just basically saying most people don't know what they don't know. So get the education, sit with your financial professional, and see if it works.
Absolutely.
Make a decision, but make an informed and intelligent decision.
Right. Yeah. Because those are the best decisions, right? The decisions that the people are most comfortable with is when they sit down with you and you can give them sort of a primer and give them an explanation of exactly what and why this might or might not be suitable for each individual client, right? When they can, not that they're going to know everything about private equity, they know enough to make an informed decision. That's where it really gets powerful, right? But how do we know?
And the other thing too, Mike, that I think people need to be aware of is the companies that are doing what your company's doing. There's going to be a whole bunch of them out there right now that are saying, hey, we got the corner on how to invest in private equity, right? Or in the private markets, and they're all built different. They all have different rules. And so again, make sure that you understand what's really going on behind the scenes as much as possible.
Yeah. Do your homework, be educated, and most certainly get the advice, because otherwise, how would you know? Like you said, you don't know what you don't know. And there are a lot of, if you go back about 4 or 5 years in private equity, there was roughly about $3.5 trillion in assets under management by all these private equity companies. Today, it's closer to 11 trillion. So to your point, you've got a lot of people, because a lot of people sort of fit in that same camp. I'm not sure the 60-40 stock and bonds is going to get me where I need to be over the next 10 or 20 years. And you got a lot of people trying to capitalize on that don't have level expertise and knowledge to provide those investments to your clients. And just like, there's 10,000 mutual funds, there's a lot of private equity funds too. So you got to do your homework. Yep. And you got to work with somebody that can sort of vet, because there's a lot of them, and sit down and meet with them and get that initial clearing that these guys are good. They know what they're doing. They're professional, they're legitimate, great track record, great history, and we can trust them.
Totally agree. Well, Mike, thanks so much for agreeing to join me here on the Guided Retirement Show. I'm sure that everybody listening on the podcast has learned something. I'm sure that everybody that's watching us on YouTube has learned something as well. So thanks again for your time.
I enjoyed it. Thank you very much, Dean.
Thanks so much for joining us on the Guided Retirement Show. I'm your host, Dean Barber. If you'd like to have an opportunity to visit with one of our certified financial planners about the opportunity to invest in private equity, you can always go to a link in the show notes where you can find a link to our calendar to set up a quick time for a conversation. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home. I hope you enjoyed my conversation with Mike Faciana. Thanks so much for joining us on the Guided Retirement Show.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.